Hello learners. In the previous lesson, we learnt about payback period method as well as ARR method. Both of these methods are categorized as non-discounted cash flow methods. Non-discounted cash flow methods are the one in which time value of money is not considered. Under payback period, we defined that payback period means such time period by the end of which our investment in the project gets recovered with the help of cash flow after tax. Whereas under ARR method, we used profit after tax. So you can see the difference. Under payback period method, we used cash flow after tax. Under ARR method, we used profit after tax. ARR we defined, that is accounting rate of return or average rate of return, such rate at which we generate return on our investment. So ARR can be defined as return on our investment considering profit after tax. Acceptance and rejection rule also we learned. Under payback period method, all the projects which have payback period less than or equal to the given cutoff point are accepted. And as explained, in case of payback, less is better. Why less is better? Suppose a businessman says, my cutoff point is 1.5 year. It means he wants that his investment in the project should get recovered by the end of 1.5 year from the beginning of the project. And always remember, sooner we recover our investment, less risky is the project. Early we recover in our investment, project is considered less risky. So the concept of the businessman or the executive who is using payback period as criteria for evaluating a project, he is avoiding the risk. He is risk averse. He wants that his money should come back quickly to him. So that is the theory behind payback period method. Similarly, under ARR method, more is better. Definitely, when we say return in percentage, so higher the better. Always remember, all the projects for which ARR is greater than or equal to the given cutoff point are accepted, else rejected. ARR, if you remember, we calculated on two bases. One was ARR on average investment and another was ARR on total investment. In an examination question, if nothing is given, always calculate ARR on average investment. So let us practice some questions on both of these so that you are expert in that one. Let us begin that. This is the rule I have just explained you for payback period method, how to decide whether a project is acceptable or not. This is the rule under ARR method. Now we proceed further. Initial investment is rupees 50,000 and annual cash inflow is 10,000 for 10 years. Tax rate for the company is 30%. Calculate payback period and ARR. Now pay the attention. Step number 1 you have to take. Step 1 for payback period. Estimate cash outflow or investment in the project. And this investment may be either in fixed assets or in working capital, hardly matters. Investment may be either in the beginning or subsequent investment might be there. Under payback period method, sum up all the investment, sum up all the cash outflow required for the project or given for the project. In our case, cash outflow is 50,000. And annual cash inflow is 10,000 for 10 years. So we are given, so that was the first step. Second step is estimate cash flow after tax. And we are given 10,000 per annum for 10 years. 10,000 per annum for 10 years. So 10 years is the life of the project. We are also given tax rate. But right now, this tax rate has no meaning because we are given straightforward cash outflow and cash inflow. As you can see, cash inflow is like an annuity. That means every year we are getting 10,000 for 10 years. So it becomes an annuity, the regular annuity. Now we can calculate payback period. Payback period is equal to cash outflow, or you can say investment, divided by annual cash inflow, annual CFAT. You will get a straightaway answer for the payback period. 50,000 divided by 10,000, you get it 5 years. And that is apparent also. Your total investment of 50,000 gets recovered by the end of 5th year. So that is how when cash inflow is given like an annuity, we calculate payback period in a simple manner. So that was the first requirement in this numerical, calculate payback period. Now pay the attention, we have to calculate ARR. So let us proceed further how to calculate ARR. Now for calculation of ARR, first step is calculate average investment, because I will be calculating on average investment. So average investment formula we have. So average investment is equal to cost of asset minus salvage value multiplied by 1/2 plus salvage value plus working capital. Now we are given initial investment is 50,000. It is not specified whether this 50,000 is for fixed assets or for working capital, or some part is for the fixed asset and some part is for the working capital. So pay the attention. If numerical is silent, question is silent, consider this 50,000 as cost of fixed assets. So in our case, cost of fixed asset is 50,000. Salvage value not given, so we assume it to be 0. Divided by 2 because meaning is same. Add back the salvage value, add back the working capital. So we get average investment 25,000. So first step is done, average investment. Now we calculate average profit after tax. That is sum total of profit after tax divided by number of years. So number of years is known to us, 10 years. But are we given profit after tax? Definitely not. So what to do? Just think over a situation, what we are given. We are given annual cash flow, that is annual CFAT. So that should remind you what is the formula for cash inflow, what is CFAT or how it is calculated. So if you remember, CFAT is equal to profit after tax plus depreciation. Profit after tax plus depreciation. Now CFAT is given to us. That means CFAT is 10,000 year on year. So we are given CFAT 10,000 year on year. Profit after tax is not given. But we can find out depreciation. Because anyone who has arrived at CFAT, he must have added back the depreciation to profit after tax. So what might have been the depreciation? Pay the attention. Cost of asset is 50,000, salvage value is 0 and life is 10 years. So annual depreciation is equal to cost of asset minus salvage value upon life. I hope you remember that formula, and by default we use straight line method. So in this case, annual depreciation might have been charged as 5,000 rupees. So 5,000. So what we do? We solve this equation for profit after tax. So profit after tax will be 10,000 minus 5,000. So we get it 5,000. So by chance, amount of profit after tax and depreciation are the same, but this is the way we can convert CFAT into pure profit after tax. Since every year it will be the same, so we need not to sum it up. Even if we sum it up, that means over a period of 10 years, total profit will be 50,000. Life is 10 years. So average profit after tax is 5,000. So we get average investment 25,000, average profit after tax 5,000. Now what else is left out? Apply the formula of calculation of ARR on average investment. So we have ARR equals to average profit after tax upon average investment. So that makes it 0.20 or 20%. So on average investment, we have ARR 20%. If question says calculate ARR on total investment, so what will be my ARR on total investment? My ARR on total investment will be average profit after tax divided by total investment, which is 50,000 in this case. So we get it 0.10 or 10%. So this was ARR on average investment. And this is ARR on total investment. So by following these simple steps, we can calculate payback period as well as ARR. So let us take the another numerical. Initial investment in fixed asset is 15 lakh. Investment in working capital is 1 lakh. So investment in fixed asset is 15 lakhs. Investment in working capital is 1 lakh. That means at 0 time, 16 lakh is being spent on this particular project. Economic life is 6 years with salvage value 3 lakh. That means project has a life of 3 years, at the end of which how much we are going to realize by selling the used assets or scrap value, we are going to get 3 lakh. Cash flow before tax, pay the attention, CFBT, per year for 6 years is 4,50,000 and tax rate is 30%. So how do we solve this numerical? So always remember, any kind of capital budgeting question is there or investment decision question is there, what you have to do? Step number 1, estimate cash outflow. And generally it is initial cash outflow. So in this case, what is my initial cash outflow? My initial cash outflow is on assets 15 lakhs and on working capital 1 lakh. So total investment in the beginning is 16 lakhs. Within this, you can calculate step number 2, annual depreciation. Now, if nothing is given, by default, mechanism or method for charging annual depreciation is straight line method. That says cost of asset minus salvage value divided by life of asset. In this case, cost of asset is 15 lakhs. Estimated salvage value is 3 lakhs and life is 6 years. So annual depreciation will be 2 lakh rupees. Annual depreciation will be 2 lakh. So fundamental number 2, if question is silent, then always use straight line method for charging annual depreciation. Now, what we are given further? CFBT. Now you might be surprised why working capital is not subject to depreciation. We always provide depreciation on fixed assets. Reason being, fixed assets get used up year on year, they generate the utility, and to show the utility as an expense, we charge depreciation year on year. In this case, every year company will be showing 2 lakh as depreciation in their income statement or profit and loss account, on which they get the tax benefit or tax shield. However, whatever is our investment in the working capital, on that we are not going to provide any depreciation. Reason is simple. At 0 time, we are investing 1 lakh in the project on account of working capital. Same 1 lakh will come back to us the moment project is terminated. Because amount of working capital remains in circulation. The moment you stop the project, money which was held up in debtors, money which was invested in inventory, money which was blocked in prepaid expenses will come back to you. So you will recover that money and that will become part of the terminal cash inflow. So step number 1 we have taken, estimation of initial cash outflow, calculation of depreciation. Now we proceed further, step number 3. So these are the 3 basic steps for every kind of method of capital budgeting. So third step is estimation of cash inflow, and we will be estimating both operating cash inflow as well as terminal cash inflow. What is my operating cash inflow? So look at the question. We are given CFBT, and cash flow after tax is simply profit after tax plus depreciation. So in this case, we are given cash flow before tax 4,50,000. So we are given CFBT 4,50,000. So word cash flow signifies that depreciation has not been deducted out of that. So let us deduct depreciation first. So we calculated depreciation year on year 2 lakh. So I am left out with profit before tax. So the moment depreciation is deducted from CFBT, we reach at profit before tax 2,50,000. Now we are given a tax rate of 30%. So 30% tax will be applied on profit before tax. So tax is 30% on 2,50,000, that means 75,000. Tax is 30% on 2,50,000. We are left out with profit after tax 1,75,000. So we were given CFBT. Now since every year it is same, so we need not to do it 6 times, because every year you will get a profit after tax of 1,75,000 rupees. Now come to this point, how much will be CFAT? Either you can continue the table or you can use this formula. So it will be profit after tax 1,75,000 plus depreciation of 2 lakh which we deducted. So annual cash inflow is 3,75,000 rupees. So year on year till the life of 6 years, project will generate 3,75,000 as cash inflow. That is operating cash inflow, remember. So within third step, estimation of cash inflow, we have calculated part A, operating cash inflow. That is 3,75,000 per annum for 6 years. Then we calculate terminal cash inflow. So this is operating cash inflow year on year 3,75,000. We further calculate terminal cash inflow. As you remember, terminal cash inflow will comprise of two things: salvage value plus recovery of working capital. So my salvage value of the project is 3 lakh, because we will be selling the scrap or used project at 3 lakh. At this moment, since nothing is given, it means there is no profit or loss on sale of old project, because we have 3 lakh salvage value and the same salvage value is coming. So at this point of time, at the end of 6th year, my book value of the asset is already 3 lakh. How it is 3 lakh? You can justify. Cost of the asset was 15 lakh. And over 6 years, total depreciation applied is 12 lakh. Because year on year, we were applying the depreciation 2 lakh. So accumulated depreciation for 6 years becomes 12 lakh. So book value on the date of termination is 3 lakh. And we are selling the project at 3 lakh. So there is no profit, no loss. So as such, after tax salvage value or salvage value remains 3 lakh, and we will recover back 1 lakh as working capital also. So terminal cash inflow is 4 lakh. So we did all the basic steps of capital budgeting methods. Now we will apply the mechanism of payback period method and ARR. So now we have payback period is simply investment, that is total investment in the project divided by annual cash inflow. So our total investment in the project is 16 lakhs. Annual cash inflow is 3,75,000. So 16 lakh divided by 3,75,000, 4.27 year. 4.27 year. It means our total investment of 16 lakh will get recovered by the end of 4.27 years. Now remember, in general, we never consider terminal cash inflow while calculating payback period. However, if we are running short of cash inflow to recover the investment, in that case only terminal cash inflow will be considered. So in normal circumstances, never consider terminal cash inflow for calculating payback period. However, if your operating cash inflow is not sufficient to recover your investment, in that case only we consider terminal cash inflow to be used for arriving at payback period. So in that way, we have calculated payback period 4.27 year. Now second, we have to answer ARR. So remember, we will be using average profit after tax, and if you remember the figures, we had average profit after tax also in the previous slide, and we will arrive at that also again. Let us start with that. Steps for ARR are simple. Steps for ARR are simple. Number one, calculate average investment. Now, what is my average investment? If you remember the formula, I am writing it again. Cost of asset minus salvage value. So, scrap value or salvage value we are given, divided by 2 plus salvage value plus working capital. So what is my cost of assets? 15 lakhs. Salvage value is 3 lakh. Divided by 2 plus 3 lakh and plus working capital. So what we get? 12 minus 3 becomes 15 minus 3 becomes 12. 12 divided by 2, 6 lakhs. Plus 3 and plus 1. So we get it. My average investment is 10 lakh. My average investment is 10 lakh. So first step is calculate average investment. You can focus on the formula. Remember this formula in an examination because you will not be provided with the formula help or formula sheet. So first step is average investment. Second step we will be taking calculating average profit after tax. If you remember, we had CF80, 3,75,000. Although in the previous slide we also had the profit after tax. Profit after tax year on year was 1,75,000. Now we proceed further using this profit after tax because every year it will be 1,75,000. So it becomes average itself. So now we can calculate ARR. ARR on average investment is equal to average profit after tax upon average investment. So average profit after tax is 1,75,000. Average investment is 10 lakh. So that gets me 0.175 or 17.5% per annum definitely, and for 6 years. Per annum for 6 years. That means on your average investment year on year you will be earning 17.5% return for 6 years. So that is ARR on average investment. If we calculate ARR on total investment, if we calculate ARR on total investment, it will be ARR on total investment is equal to average profit after tax upon total investment. So average profit after tax is 1,75,000. Total investment will not be 10 lakh. Remember, what is my total investment? 16 lakhs. So 1,75,000 divided by 16 lakhs. So you have to plug in the total investment. Don't do the mistake that you are plugging in average only. So your answer is 0.1094 or 10.94%. So let me verify again. Yeah, 10.94%. That means to say on your total investment of 16 lakh rupees, on an average every year you are earning 10.94% return for 6 years. For 6 years. So that is the way we calculate ARR on total investment. Now in this case we are not given cutoff point. So we cannot evaluate whether this project is acceptable or not. However, the moment cutoff point is given, let us say cutoff point for ARR is given 10%. Now this 10% and how much is the ARR? On average it is 17.5. Yes, project will be accepted. On total it is 10.94%. Yes, project will be accepted. On the other end, if cutoff is given 20%, project will be rejected. So by default, we always consider ARR on average investment. So that is the way we can easily calculate ARR given the situation. That's what we have practiced about. Now if I simply give you one more question, let us practice the last question of this session. Now what is the situation? We are given cash outflow on two things: fixed assets 2 lakhs, working capital 0.5 lakh. So at 0 time cash outflow is 2,50,000. project will generate profit after tax. So if I put it on the timeline, so project has a life of 5 years. Project has a life of 5 years, and profit after tax year on year will be like this. It will be 0.75 lakhs. All the values are in lakhs. 1.25 lakh, 1.5 lakh, 1.5 lakh, and 1 lakh. There is no salvage value. Calculate ARR and payback period. Now look at the fact what we are given, profit after tax. It means anyone who might have calculated profit after tax must have deducted depreciation on the asset. And our investment on asset is 2 lakh. So what might have been the annual depreciation? Your annual depreciation might have been 2 lakh divided by 5, that is 0.4 lakh. So add the depreciation. You have not deducted, but anyone who calculated profit after tax must have deducted that. It means on all the values, we will be adding the depreciation to convert that into cash inflow. Because for calculating payback period, I need cash inflow. So my CF80 is 1.15, 1.65, 1.90, 1.90 and 1.40. That is operating cash flow after tax year on year will be like this. Apart from that, we will have terminal cash inflow. Since salvage value was given 0, but we have invested 0.5 lakh in the working capital. So in the 5th year, we are going to get the terminal cash inflow also. We are going to get terminal cash inflow 0.5. So in the 5th year, total cash inflow will be 1.9. But remember, in normal circumstances, we never use terminal cash inflow for calculating payback period. Instead, what we do, we only use CF80. However, in accumulation, we might do it, that's not a problem. Now, this is the scenario. Our investment in the project is 2.5 lakh. So when I say calculate payback period, that means such time period by the end of which my 2,50,000 gets recovered with the help of cash inflow. So let us do it. Cumulative CF80. So by the end of first year, it is 1.15. By the end of second year, add up these two. So 2.90. By the end of third year, add up these two. So it will be 4.8. It will be 4.8 lakh. By the end of fourth year, 6.7 lakh. And in accumulation, we always use terminal also. So by the end of 5th year, add up these two, 8.6 lakhs. Now, make the observation after accumulating the cash flow after tax, in which particular segment 2.5 is there. In which particular segment 2.5 is there. So you can see 2.5 falls between first and second year in the cumulative cash flow after tax. So your payback period is complete 1 year plus some fraction of the second year. Now what is your target? 2.5 lakh. And how much we have recovered by the end of first year? 1.15. So take a difference between 2.5 and 1.15. So we are left out with a gap of 1.35. It means in second year, as soon as we reach at 1.35 landmark from cash inflow, we recover our total investment. And how much we are getting in second year? 1.5. So divide this with 1.65, sorry. In second year, we are getting 1.65. So we get payback period equal to 1 plus, so 1.35 divided by 1.65, 0.82. So 1.82 year. So our payback period is 1.82 year. So a recap, our purpose is to get the time period by the end of which we recover 2,50,000 with the help of cumulative cash inflow. So under cumulative cash inflow, you see 2.5 will be somewhere at this point between first and second year. That means complete 1 year and some fraction of the second year will be devoted. Now what is my target? 2.5. So by the end of first year, I have recovered 1.15. So how much is the deficiency to make it equal to 2.5? That is 1.35. So we get the payback period, complete 1 year, and then in how much time fraction or proportion of the second year, 1.35 will be recovered. Whereas total cash inflow in the second year is 1.65. If you solve this, you will get it 1.82. So your payback period is 1.82 years. So that is the way we have calculated payback period. Now we can calculate quickly ARR also. Now what are my profit after tax given to me? Sum up those profits and divide by 5. So 0.75 plus 1.25 plus 1.5 plus 1.5 and plus 1. So that makes it 6. So total profit is 6 lakhs. Total investment is 2.5. So I will be taking you to the next slide and we will work out ARR. Remember the figure, total profit after tax for all the 5 years is 6 lakhs. Investment is like this. So we have total profit after tax 6 lakhs. Life is 5 years. Now we have to calculate average investment. Cost of asset minus salvage value upon 2 plus salvage value plus working capital. So we get it 1 plus 0 plus 0.5, that is 1.5 lakh. So step number 1 under ARR is calculate average investment. Then step number 2, average profit after tax. So our total profit is 6 lakhs in 5 years. So 1.2 lakh. So first step we have taken, second step we have taken. Now we can proceed further for calculating ARR on average investment. That is pretty simple. Profit after tax, that is average profit after tax upon average investment. So how much we get it? 80%, I hope. Yes, 0.80 makes it equal to 80%. It means 80% per annum for 5 years, for a period of 5 years. So on an average, on your average investment, you will be getting 80% return. And if I ask you to calculate ARR on total investment, ARR on total investment, so average profit after tax upon total investment, which is 2,50,000. So 1.2 divided by 2.5, that makes it 48%. 0.48 is written as 48%. 48% per annum for 5 years. So that is how we calculate ARR on total investment. So dear learners, I hope we have practiced both the methods, payback period method as well as ARR method. Both the methods fall in the non-discounted cash flow techniques, that is the techniques in which time value of money is not considered. So in this video, up till this now, in next video we will learn about discounted cash flow methods, that is NPV, profitability index and IRR. Till then, keep on learning. Wish you good luck.